So let's talk about what a mortgage is, right? This is a very common term that people hear very often. It's basically just a loan that is taken out to purchase a property. Let's talk about what it includes, right? So first, some couple terms you will need to know to understand mortgages better is first down payment, right? It's an upfront payment that's made by the borrower towards the purchase price of the property. So with a mortgage, you're borrowing money usually from a financial institution, or you can also borrow from the seller, right? That's called seller financing. Usually the down payment is 20%. Financing is basically obtaining funds or a loan to purchase asset or property, right? So you're not buying it all in cash. You're part of it's a loan. Lenders are financial institutions, typically, right? Banks, credit unions, mortgage companies that provide loans, right? It can also be the seller or more private. In terms of mortgage loans, points refers to upfront fees paid to lenders to exchange for a low interest rate. They usually 1 point would stand for 1% of the purchase price. Refinancing. It's the process to obtain a new loan to replace the existing loans, often with more favorable terms or access to equity in the property. After a couple years, after you get more equity on the property, you can apply for refinancing and you could switch from a adjustable rate mortgage to a fixed rate mortgage, or from a fixed rate mortgage to adjustable rate mortgage. And that can decrease your interest rates as well as get you better as well as get rid of PMI, private mortgage insurance. So often with buying real estate, there are many tax implications. So we're going to talk about some of the tax benefits. So mortgage interest is tax deductible, right? We talked about what this term means earlier. Property taxes are tax deductible. Real estate losses are tax deductible up to $25,000 if you're under a certain income, which is $100,000. If you're under $100,000 income, your real estate losses are tax deductible. You can also have a depreciation schedule to depreciate the price of or depreciate the value of the actual property. This can only be taken with property, not land. Always consult with a tax professional with these things because these are very complicated, especially in relation to real estate, always pretty complicated, and you don't want to make a mistake with paperwork because a mistake can lead to big losses. Let's talk about some things that make real estate more accessible. A 1031 exchange and FHA loans. A 1031 exchange is also known as a like-kind exchange or a tax-deferred exchange. It's basically a provision that allows investors to defer paying capital tax gains from a sale of real estate. So how this works is that after the initial property is sold, the taxpayer has 45 days to identify a potential replacement property. Then it has to be written down on a piece of paper, and the taxpayer must acquire one or more replacement properties within 180 days from the initial sale of the property. So this is really powerful because taxes are one of the main expenses of anyone, right? So being able to push off paying capital gains tax is extremely powerful because that makes relocating investment property easier, right? So if I want to move to another area, right, from say New York to Tennessee, right, having this like kind exchange makes it so that if I want to sell my house in New York and get a house in Tennessee, I'm able to move because it's tax deferred, right? I don't have to pay taxes on that, and that makes the choice easier. With FHA loans, it's designed to make home ownership more accessible, especially for first-time home buyers. So this is a mortgage loan insured by the FHA, often have more flexible criteria and allow for a lower down payment as low as 3.5%. right? And requires mortgage insurance premiums. These are for first-time home buyers. What's super important here is having a good credit. If you have a strong credit history and high credit score, it demonstrates to lenders that you are more reliable, and it allows you to qualify for lower interest rates, which over the course of a 30-year mortgage, which mortgages are typically 30 years, uh, the amount of interest you're paying less could be quite substantial. So hopefully that's giving you some insight on what a mortgage is, as well as some tax-related things to real estate.